Hey, what's up, Dividend Nomads? Welcome back to the channel. Today, we're going to talk about volatility in your portfolio. And I'm going to share with you my small account because my small portfolio is very volatile. And I'm going to share some stuff with you guys about that today. And because a lot of people are very scared, I guess, of volatility. And which volatility can be good, but it can also be bad. So we're going to talk about all that today. First of all, let me record the screen on my phone here and share my account with you, and then we'll get into that discussion. 3, 2, 1, bam. Okay, so today we're looking at my small portfolio. This is just like a small account challenge where I put like $300 a month in here and just try to grow it, try to get to $1,000 a month. Now, this isn't my only portfolio. I actually have other portfolios that I actually use to live out of here in Asia, but this is just a fun portfolio, right? So let me open this up. So here we are in my Webull account. I'll refresh it for you. This is 7:52 in the morning here in China. So we might be moving around a little bit because it's still in the post market. 5,571 is the value. So you can see the value did drop. I've got $38 in cash. And I've only got 3 positions here: HOOW, PLTW, and WPay, which basically, if you guys have been following along, you already know HOOW is a leveraged version of Robinhood. So when it's leveraged, like, it's gonna be volatile, which Robinhood, a stock like that, is volatile anyway. And then PLTW is the same thing, a leveraged version of Palantir, which Palantir is also very volatile. So you're going to have a lot of volatility in a portfolio like this. And WPay is the basket of a bunch of volatile funds. So my portfolio is going to be very volatile. It's going to move up and down quite dramatically. But for me, in this small portfolio, I'm okay with that because this is just for fun, like I said. But in a larger portfolio, I wouldn't have such volatility, because in the larger portfolios, I'm actually use that money to live off of, and you want stability, not volatility. So it really depends on, on your risk tolerance in terms of volatility. Because some people just can't stomach it, and some people will sell everything and sell it at a loss, and that's not, in my opinion, that's not the way to do it. If you're selling everything and selling it for a loss, you didn't have much conviction in those plays anyway. That's trading, and volatility is your best friend when it comes to trading. You're supposed to use the volatility to actually make money. That's how day traders make money. I used to day trade, and that's what you look for, is like very volatile stocks, so you can go long or go short and make a bunch of money in a short amount of time. But volatility can be bad when you're talking of holding something long term and trying to stomach that, because when people see their account goes down and 10% in one day because they're holding something very volatile like HOOW, we can drop 10 or 15%. I mean, at the blink of an eye. Some people find that hard to stomach, and that's why I don't have such volatility in my regular portfolios. So this is something to keep in mind. But the reason why I didn't sell my stuff and held on during all of that stuff, right, during all of those problems, is because I don't mind the volatility in this small account because it's just for fun. Anyway, HOOW, I've got 20 shares, 63.98. We'll get back to volatility in a minute. PLTW, I've got 24 shares, 41.85. And WPay, I've got 69 shares at 52.40. And every single one of these is down right now. Really quickly, though, let me share this with you guys really fast. Let me show you the history. So here's my recent dividends received. 1941 from PLTW. This is this week. 27.54 and 37.25. These are the 3 that I received this week, but I received more in total for the month, and I'll share that with you guys in a minute. But yeah, as I was saying, if you're doing the small account challenge, like with me, if it's your only portfolio, your one and only portfolio, and you have nothing else, you're probably gonna want some stability in your portfolio. And the things that I'm holding right now are not stability. Let me see. Let me record the screen. 3, 2, 1. Bam. All right. So here's my spreadsheet real quick. And HOWWP, this is what I just showed you, the shares I just showed you, all that stuff. And let me show you how volatile these things are. Let's go to the market returns and the total returns and all of that. So you can see in this particular, well, you can't see nothing. This stupid spreadsheet's acting crazy. All right, there. Oh, there it is. You can see it there. Maybe let me make it bigger so you can actually see it. Hopefully, I can do this without messing it up. What the hell? This thing is annoying, man. Piece of shit. Okay. Anyway, there. That's good as you get. At the top, you can see HOW. It's red all across the board, and WPay, same thing. And POTW, same thing. But you can see this is just small amounts of money, right? You can see it's not a large amount of money. If you see like the total return is down 156, 1980. So it's not down a whole lot, even though it's super volatile, because this isn't a large portfolio. But if it was a large portfolio, I would not be doing this because I don't want this type of volatility in something that I'm trying to live off of. So that's what I'm trying to say. If you have like one and only one portfolio, and you want to take part in let's say income investing, I guess it's better to choose things that are less volatile. So what can you avoid? Basically any round hill single stock ETF, they're going to be super volatile. Even WPay is going to be very volatile because it holds all the leverage ETFs, all the yield max funds, every single one of them going to be very volatile, and they're just going to, your portfolio is going to have massive downward swings and not upward swings. At least with round hill ones, you can go up as well as down, either way, the same in either direction. But if you want stability, you need to be looking at more index-based funds, stuff like SPYI, QQQI. For me, in my stable portfolio, XDTE has kind of been my steady eddy. Like it doesn't go down very much. It can go up if the market's going up in the longer term. It pays steady, right? That's the one that I'm using. But I think SPYI, QQQI, and just the new one, the TSPY, TSPY, GPIC, and GPICs, both of them are really good plays if you want some stability. But of course, their yield's not going to be as high. You're not going to get as much income, but there's always a trade-off, right? Do you want stability or do you want a lot of income? And if it's your only portfolio and you can't stomach volatility, then I'm going to say you probably want more stability. And it's something that you just learn over time by being an investor and like recognizing what your tolerance is, right? Like what can you actually tolerate? And if you see your account going down and you feel sick to your stomach, then you should probably change your style, right? Change your investing style, do something else. That being said, here's some of my dividends right here. November, 27.54 from HOOW, 58.82 from WPay, 19.41 from POTW. And if you look over here, I got some sold positions, 63.26, because I got paid from HOOW at the beginning of the month. Then I sold it to avoid a major downturn. And then I got caught in one anyway. But I had a lot of shares at that time, and now I don't have a lot of shares. So I made my portfolio a little bit more stable by having a bigger chunk in the basket instead of single stocks. But anyway, I still got paid 63 from that, which gives me a total of 169 so far for the month. And let me see how much days I got left. What's today? The 15th. We're still gonna get, let's see, 1, 2, 3, 4, 5, 6 more payments with what I have. I'll get 6 more payments this month. So that should definitely get me over my $200 rent goal anyway. 407 last month. I don't think I'm going to get that this month, but as long as I get over $200, I'm fine, because this portfolio's whole goal is to just pay my rent here in Asia, which it's going to do. So anyway, that being said, in terms of the volatility and recognizing your risk tolerance, you just really have to be self-aware. Like when you're investing and you go through an episode like this that's very volatile and you see your portfolio going up and down, like how does that actually make you feel? Does it feel scary? You're like, oh shit, I'm like losing a bunch of money and I can't afford to lose that money. If you feel that way, you know, take note of it and recognize, because that's the only way you're going to learn, is actually recognizing your mistakes, or not even your mistakes, but just recognizing yourself and your tolerances. Because some people, they just go through this and they don't learn any lessons from it because they're not self-aware of their own self, of like what they can tolerate, what they can't tolerate. And that's one of the biggest things that you really need to learn about yourself as an investor. Can you stomach this kind of thing? And is it smart to stomach this kind of thing, right? Now, you know, if you have one portfolio and you got, you know, $50,000 in it and it's all in MSTY, and you know, it goes down, and based on the charts and the history of MSTY, it's probably not going to go back up, right? And like, that would be like a stupid mistake, you know what I'm saying? Like holding on to something that long like that, when you know and you've seen the charts and you know what it's been doing and you keep holding it, right? That's a good time to sell. But when you're in something newer, like these round hill funds, like we don't know exactly what they're going to do, because they don't have a long track record, don't have a long performance history. So it is a little bit more different. But if, like I said, if you're the type of person who's like, just feels sick to your stomach when you see your account going down, you should probably do something different. And it's just, you got to learn to recognize these things about yourself. And like how I learned this was through day trading. So I used to do day trading for several years. But I'm living here in Asia. It kind of sucks because of the time difference. You guys stay up all freaking night looking at charts and your eyes hurt. And then you sleep all day, and it's not cool, right? So I quit doing that. But that's how I learned a bunch of this stuff. Or some actually day trading and losing lots of money and making lots of money at the same time. But, you know, when you lose a lot of money and you feel like, you just feel like sick, like you don't even want to look at a chart for a week because you lost a bunch of money, you learn something about yourself. You learn like, maybe I took on too much risk. But then so you go back and look at what you did, and then you learn, okay, I did that and I did not feel good about that. I'm not going to do that again. And even used to write like have sticky notes, and I write like a sticky note and literally stick it on my computer screen where I'm looking at the charts every day. And then every time I get tempted, I look at that note and I remember, yeah, I did that before and it wasn't very nice. And I don't make that mistake again. So just something to think about in terms of volatility and that kind of thing. And just want to share that with you guys and share my small account with you guys. And I'll be back tomorrow with an update of one of my larger accounts and share that with you as well. So y'all take care, and I'll see you on the next video.